Let's do our first company accounts exercise. Legacy Limited is a retail company and is well known as a quality mobile phone retailer. The company is not registered for that. The company was incorporated with an authorized share capital of 1 million ordinary shares, 250,000 5% cumulative compulsory redeemable preference shares, 100,000 10% convertible non-cumulative preference shares, and 200,000 6% non-cumulative preference shares. All the shares are no par value shares. Now, what is important to note is that is not the issued share capital. That is the authorized share capital. In other words, that is the number of shares that the company is allowed to issue. And it doesn't matter at what time, but they are allowed to a maximum of 1 million ordinary shares, 250,000 cumulative, blah, 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 blah. Now, I had a question from a student who asked me what happened now, for instance, that they've already issued 1 million ordinary shares and they need to issue more shares. Does that mean they cannot issue any further ordinary shares? The answer is yes and no. Yes, they can, but they have to do a few things first. The first thing that they have to do is that the shareholders have to take a special resolution on the general meeting of the shareholders annual meeting. Then after the shareholders has approved the additional issue of ordinary shares and the increase in the authorized share capital of ordinary shares, this special resolution needs to be registered with SIPC. Once it is registered with SIPC, they have to change their memorandum of incorporation, and then they can authorize and issue more ordinary shares thereafter. So once you reach your ceiling, it's not the end of the world, but there's quite a process that you have to go through in order to increase your authorized share capital. The following information for the year ended 30 June 2014 was extracted from the financial statements of Legacy Limited. There were 600,000 ordinary shares in issue and the share capital amounted to 9.8 million rand. All preference shares were issued except for the 6% non-cumulative preference shares. And the share capital amounted to 1.2 million for redeemable preference shares. Got a stupid mind. And 600,000 for convertible non-cumulative preference shares. So my ordinary share capital, that was 1.2 million rand. Now remember what we said about compulsory redeemable preference shares. We say compulsory redeemable preference share has the same attributes as loans. I have a fixed repayment date where I have to repay the full amount of the capital that was issued. And furthermore, there's a fixed dividend percentage attached to that, in this case 5%. So therefore, I have to repay every year a 5% dividend on the capital amount. So on the 600,000, there's a 5% dividend that is payable on an annual basis. I have to make good for it because it is a cumulative share. That means if I do not declare a dividend this year, I have to pay it next year. So therefore, I'm going to always have to make provision for that dividend payment, even if I don't pay it this year, but I have to create the liability in my books this year. Also, that dividend applicable on the redeemable pref share, we do not classify as a dividend. We do not do that, and the receiver of revenue doesn't do that either. So we, both of us and the receiver of revenue, classify that dividend as interest. What is the ramifications of that? There is no dividend withholding tax on that dividend on the redeemable pref share. Furthermore, the dividend in inverted commas that we're going to work out on that redeemable preference share, we are going to treat as interest in our books. So we will have an interest expense in our books opposed to a dividend in the statement of changes in equity. The retained earnings amounted to 67,12324 on 30 June 24. So this is all opening balances. And profits for the year ended 30 June 2015 amounted to 848,648. So this is now my statement of changes in equity. This is my retained earnings for the year, and that is that amount of 848,648. Great. Let's do the profits also in green. When we come back to the question, we know exactly what we add. Then during the financial year, the directors of Legacy decided to expand the business by including a new brand that was recently introduced to the market. They had various options to raise funds, but after much deliberation, it was decided to use the following options. Now, you are required to provide the journal entries to account for the above transactions in the books of Legacy for the year ended 30 June 2015. Journal narrations are not required. And then you have to prepare the statement of changes in equity of Legacy for the year ended 30 June 2015. So let's start then with the journal entries that we want to prepare. They have decided to issue 250,000 ordinary share at a market value of R5.30 per share. Applications for 240,000 shares were received by 30 November 2014, important. And the shares were allotted accordingly on the next day. Share issue costs amounted to 14,600 and were paid in full. Now, the first thing that you have to ask yourself whenever there's going to be an issue of new shares, was the share issue underwritten by an underwriter? If the answer is yes, well then we said we wanted to raise 250,000, issue 250,000 shares at R5.30, and we will eventually issue 250,000 shares at R5.30. Although there was only 240,000 applications, so the shortfall of 10,000 shares would have been taken up by the underwriter. Nothing here tells me that an underwriter was involved. Although there was share issue cost, nothing happens for free. There's always share issue cost, but share issue cost is not necessarily underwriter's commission. Underwriter's commission is something that is completely on its own. So, if we have issued, how much shares have we allotted? How many applications have we received? There clearly, applications for 240,000 shares were received. So how much money did we accumulate until the last day that applications could have been received by the entity? Only 240,000. So the amount that we have accumulated in our bank account over that time period since applications, the date of applying for the share has started up to the date that it has closed, they have accumulated R5.30 multiplied by 240,000 shares, i.e. 1,272,000 Rand. So I would have debited bank in the statement of financial position. Remember your statement indication, otherwise you're going to lose half of your marks. And I'm going to credit my application and allotment account for ordinary shares, 1,272,000. And then the directors have allotted these shares. There was no underwriter, so I can only allot the 240,000 shares. So I would have debited the application and allotment account, statement of financial position. I would have credited my ordinary share capital account in the statement of changes in equity. There it is, SOCI. Statement of changes in equity. And that was 1,272,000. The directors also decided to redeem the 5% redeemable preference shares on 31 December 2014. Now, what was the share capital for the redeemable preference shares? We see that it was 5% redeemable preference shares, and that amounted to 1.2 million Rand. Except for the 6% non-cumulative shares and the share capital 1.2 for redeemable preference shares. So in total, 1.2 million for the redeemable preference shares, a 5% shareholding. What was the beginning of the financial year? 1 July. Where are we now? 31 December, 6 months down the line. So what do we have to do in the first place? Well, in the first place, we have to make provision for the dividend, i.e. the interest on that 1.2 million times 5% for 6 months. And then we can redeem the share. Now, what is the amount of the redemption? How much share capital are we going to repay? 1.2 million rand. Another question goes further, and they state that the redemption of the preference shares were funded. If I have to pay somebody an amount of money, I must have money in my bank account in order to pay that person. So if I don't have money in my bank account and I have to make a payment, I must get an amount in my bank account deposited first before I can actually do any payments. So what they say is, this funding of the redemption 1.2 million minimum, because that's the capital amount, were funded by the sale of a motor vehicle. The vehicle was bought on 1 September 2013 for 400,000 and was depreciable over 5 years on the straight line method. The vehicle was sold on 31 December 2014 for 400,000 rand in cash. Remainder of the redeemable preference shares were paid by issuing 150,000 6% non-cumulative preference shares. Now please, for heaven's sake, don't get all confused now. Here are 3 different transactions in this one paragraph. What are they? Number 1, I have sold a motor vehicle. What do I do when I sell an asset? I ask myself, did I use the asset in the current year? Yes, I did. I've used that asset for 6 months in the current year. What did I provide for depreciation already? No, I haven't. So that is my first step. Provide for the depreciation for the period that I've used the vehicle. Then what do I have to do? I have to dispose of the vehicle. It's a normal transaction. Take the cost price out, I take the accumulated depreciation out, I transfer it to the asset disposal account. What do I do then? Then I look at the proceeds. So I debit bank 400,000, I credit my asset disposal account with 400,000, and then I work out the profit or loss on the sale of the vehicle. One transaction with a lot of underlying transactions associated with that. What happened then? Then I had 400,000 rand in the bank. How much money did I need in the bank in order to repay that 1.2 million rand of preference share capital? The remaining amount is 800,000 that I need in the bank. So what did I do then? I've issued 150,000 6% non-cumulative preference shares on 31 December 2014. For what amount? For 800,000 rand. So let's go and have a look. Number 1, how are we going to do the disposal of the asset? Number 2, how are we going to issue additional non-cumulative preference shares? And then number 3, eventually now we have enough money to redeem those preference shares in our books. So let's do the calculation first. The cost price of the vehicle was 400,000. The accumulated depreciation up to the beginning of the current financial year was 66,667, and in the current financial year it was 40,000 rand. So the carrying amount of this vehicle at the date of sale was 293,333. We received 400,000 rand for the vehicle, so therefore we made a profit on the sale of 106,667. So we debited bank with the amount we received, 400,000. We debited accumulated depreciation, which are those 2 amounts, the 66 and the 40. So 106,667. We took the cost price of the asset out of our books, 400,000, and we are going to report the sale. Profit on the sale, 106,667. If you made use of the asset disposal account in between, 100% as long as your asset disposal account balanced to 0 at the end of the day. Great. Then we can go back and we say, well, now we can issue the additional shares. So we received into our bank account 800,000 Rand. And we took it to the allotment account, and from the allotment account, we took it to the non-cumulative preference share capital account, 800,000. And that is in the statement of changes in equity, because it's a non-cumulative preference share, so therefore it is not the same, and it's not a redeemable preference share, so for that reason it is equity and not loan finance. So that 6% attached to that share will be treated as a dividend by both us as well as the receiver of revenue. Great. Then an ordinary dividend of 20 cents per ordinary share was declared on 31 December 2014. When is the year end? The year end is 30 June 2015. Interim dividend means it's a dividend that was declared during the course of the financial year. So clearly here it was declared halfway through the financial year. Now, dividends on ordinary shares are not time-based. So what I have to do is I have to determine how many ordinary shareholders came in line to receive this dividend of 20 cents per share. And they're going to receive the full dividend of 20 cents for every ordinary share in their possession. They say to qualify for a dividend, the ordinary and the preference shares, you should have been a shareholder for 3 months or longer. The withholding tax on dividends is 20% applicable to all shareholders of the company. So as soon as a company declares a dividend, there is dividend withholding tax that come into play. So let's check first. The qualification is you should have been a shareholder for 3 months or longer as at 31 December 2014. Here we've issued shares at what date? At 30 November 2014. So these 240,000 shares that were issued will not be entitled on this 20 cents per share. Great. We know that before we can actually declare an ordinary dividend, we must declare a preference dividend first. So I don't have to tell you that. So by implication, the fact that they've declared an ordinary dividend means that they have also declared a preference dividend. So what we have to do is we have to go and work out how many shares were in issue at this stage. Well, there was 600,000 ordinary shares in issue, amounting to 9.8 million Rand. A dividend on ordinary shares is based on the number of shares. So if we go to the dividend calculation, the ordinary dividends that will come into line for this dividend will be that 600,000 shares multiplied by 20 cents per share. So the ordinary dividends will be in total 120,000 Rand. Then we also had an issue right in the beginning, this share capital, the redeemable shares we're going to treat now as interest, and then we 600,000 for the convertible non-cumulative shares, and that was a 10% dividend rate. So let's do that one first because that is actual fact and actual dividend. So 10% cumulative pref shares would be the 600,000 multiplied by the 10% attached to that for the 6-month period. So a preference dividend is a time-based dividend, always. It doesn't matter whether we classify that as equity, which this non-cumulative share is, or whether we're going to classify that as interest, what a redeemable pref share is. All of them is time-based. Great. So 600,000, the capital amount, multiplied by 10%, multiplied by 6 months. There's the 600,000, 600,000, there's that amount, there's the 10%, and it is for a 6-month period. So the total dividend, which was declared by the company at 31 December, was 150,000 Rand. They tell us in the question here that all the shareholders of the company So with dividend withholding tax and dividends is 20% applicable to all the shareholders of the company. So therefore, that full amount of the dividend of 150,000 Rand is applicable to the dividend withholding tax of 20%, which equals 30,000 Rand. Now, our redeemable preference shares. Our redeemable preference shares was 1.2 million Rand. There it was. What was the dividend rate applicable on them? Applicable on them was 5%. What is the time period? 6 months. So 5% multiplied the 1.2 million multiplied by 6 months give us 30,000 Rand, but that is not a dividend, that is interest. So interest was equal to 30,000 Rand. So if we have to write down the journal entry, we're going to debit dividends, which is going to be closed off against retained earnings in the statement of changes in equity of a total of 150,000 Rand. We're going to debit interest expense in the statement of profit and loss for 30,000 Rand. We're going to credit shareholders for dividends, a total of 150,000 Rand. That is not right. And we're going to source dividend withholding tax. That is actually right, I'll tell you now. Dividends withholding tax equals 20%. 20% of that 150,000, which is 30,000. So that 30,000, color it in for you, that 30,000 is the same as that 30,000. Oops, not that one. Now, as shareholders for dividend is the balancing figure. So we have now discovered that 150,000 was the dividend which was declared. Okay, that one not. 150,000 was the total dividend declared, and that is that total dividend which was declared there, 150,000. So those two are the same. The interest is this 30,000. There's a lot of figures that seems to be exactly the same. So that is that 30,000. And that one equals that 30,000. So those two correspond with each other. Okay. So then the only one, the shareholders for dividend account, is the balancing figure. So 150 plus 30 is 180, 30,000 was that, 30,000, so 150,000 there. Great, now the B part of the story is we have to do our statement of changes in equity. So a statement of changes in equity has a proper heading, Legacy Limited, a line item. Statement of changes in equity for the year ended 30 June 2015. For each type of equity, only equity items will appear as a separate column in your statement of changes in equity. We have ordinary share capital, we have 10% convertible pref share capital, and we have 6% non-cumulative pref share capital, and we have retained earnings. So we're going to start with our opening balance. Going back to the question, our opening balance was right here, 600,000 shares total for ordinary share capital, 9.8 million, 9.8 million. 10% convertible pref shares, also in our question here, there it was 600,000 for convertible non-cumulative pref shares, 600,000. There was nothing of the 6% non-cumulative pref shares issued at the beginning of the year, so therefore it's 0. And then retained earnings, they gave us here somewhere at the bottom. Retained earnings, 67,12324 on 30 June 2014. And now, there it is. Now we have to account for everything that happened during the year. Now, if you go back to your journal entries, you have actually already written down everything that has happened. I have issued ordinary shares of 1,272,000. So in my statement of changes in equity, new ordinary shares issued 1,272. Here I have to list all the things that happened to every single one of these type of equity items in my statement of changes in equity. Guys, so by the way, if you have a separate column in your statement of changes in equity for redeemable pref shares, minus 5 marks. You got me. Minus 5 marks. A compulsory redeemable preference share is not an equity item and does not appear in the statement of changes in equity. Great. What also happened if you go back to our accounting entries? Here there was share issue cost of 14,600. Now, if they don't tell me in the question how I should treat share issue cost and underwriting cost, I have a choice. I can either write it off against the capital that was issued, i.e. the 1,272,000, or I can write it off against retained earnings. Both of them will be correct. So here in our statement of changes in equity, share issue costs, and I have treated it as a debit against retained earnings. But I say there in brackets any equity, so it could either have been there or it could have been here, either or, not both of them, either in the ordinary share capital section or in the retained earnings section. Great, now here we have issued new shares, 6% non-cumulative shares of 800,000. So new issue, 6% non-cumulative pref shares. So this new issue, the first time that we're going to issue this share, 800,000 Rand. Great. Now our profit for the year, and that is important that you actually concentrate here. They tell us here that our profits for the year ended 30 June 2015 amounted to 845,648 before taking the transactions below into consideration. Now, all these transactions here is only applicable on the statement of changes in equity, except for our dividend on our redeemable preference shares, which is treated as interest. So we're going to start, we have to update our profit figure. So we're going to start with the 845,648. And then if you remember correctly, we have here calculated our interest on our redeemable shares as 30,000 Rand. And we've debited our interest against our statement of profit and loss of 30,000 Rand. So our preliminary profit was 845,648. Then we have to deduct our interest of 30,000. We have to add our profit on the sale of the vehicle. That hasn't been taken into the account. The 106,667. Then we would have, and the depreciation on that vehicle that we have used for the current year, that 40,000 that we've worked out there, that hasn't been included in the 845,648 either. So that then gives us a new profit for the year of 882,315. Now, in this question, they don't give us anything about tax, and they should have said income tax I'm talking about. They talk about dividend tax, but not income tax. Now, guys, actually what they should have told us is that the income tax rate applicable to this company is 28%. And what I would have done then is I would have taken here, let's go there, I would have then added to that my taxation for the year. So let me include that. Insert. And that is only if the question told you that you have to work on a tax rate of 28%. So what you would have said here is taxation at 28%. And there it would have been 28% of 882,315, and that equals, I don't have space there, so I'm going to tell you what I'm going to do. 882,315 times 28% equals 247,048. So my net profit after tax would have been this 882,315, 635 to 67. And in actual fact, that figure there of 882,315 should have been then 635 to 67. So actually, this question would have been a much better question, and that is if they told you that the income tax rate equals 28% of the profit before tax. So then you would have carried on, because what do we show as under retained earnings? My profit after tax. So that's 635 to 67 would have been there 635 to 67. And the only thing that we haven't spoken about is then our total dividends declared for the year, and there we have that figure of 150,000 rand. So the full dividend declared, here you can see debit dividends retained earnings 150,000. That would have been accounted for there. Then we will actually calculate our new totals. So these totals will be our balances as at the end of the year. In our statement of financial position, under the equity and liability section, you're going to start with equity, ordinary share capital 11,072, 10% convertible pref shares 600,000, 6% non-cumulative preference shares 800,000, retained earnings 743,039, and then you would have had a total for equity.